Welcome to Multnomah Group's first quarter 2026 market commentary. I'm Karen Sanchez, a senior manager research analyst with the firm. Our first section is on the economy. U.S. economic growth slowed in the fourth quarter. Real gross domestic product, GDP, increased at an annualized rate of 0.5% in Q4, down from 4.4% in the prior quarter. Growth was supported by higher consumer spending and investment, but those gains were partly offset by lower government spending and weaker exports. Imports also declined. First quarter GDP will be released on April 30th. While the largest contributor to fourth quarter GDP was consumer spending, it was down sharply from the prior quarter. Government spending also experienced a sharp decline. However, the fourth quarter included a historic 43-day government shutdown. Labor market data were mixed in early 2026. The unemployment rate held relatively steady at 4.3%. Wages increased at an annual rate of 3.5% through March, indicating continued, though moderating, wage growth. Non-farm payrolls rose by 178,000 in March after a decline of 133,000 in February. Consumer confidence continued to weaken through April. The University of Michigan's Consumer Sentiment Index fell, down 8.8% from 1 year prior. In recent past surveys, lower confidence was somewhat offset by more favorable responses from those with higher wealth, as their views were supported by high investment market returns. In April, the weakening was noted across all survey cohorts. Survey respondents reported a less favorable view of current economic conditions and their personal finances, with uncertainty increasing following the start of the war with Iran. The April survey was conducted from March 24th to April 7th in advance of ceasefire negotiations. With survey respondents citing higher prices, the University of Michigan's Current Financial Situation Index hit its lowest point since 2009. Those surveyed expected 12-month inflation to rise 4.8% over the next 12 months. The Consumer Price Index, CPI, tracks consumer price changes. Core CPI removes volatile items. CPI rose sharply in March, up 0.9% for the month and up 3.3% over the prior 12 months, partly driven by increases in energy costs. However, core CPI, which excludes the more volatile food and energy prices, was up just 0.2% for the month and 2.6% over the prior 12 months. Core PCE, the Personal Consumption Expenditures Index, is the Federal Reserve's preferred measure of inflation. However, the monthly PCE report follows the CPI report by several weeks. The most recent numbers are from February, when core PCE was at 3%. Given an expected rise in inflation in March following energy shocks from the war, February's numbers are largely irrelevant. March PCE is expected to be released April 30th, one day following the Fed's next meeting. Next, we turn to the fixed income markets. Treasury yields moved higher over the quarter, with shorter-term rates rising more than longer-term rates. The yield on 2-year U.S. Treasuries ended the quarter at 3.79%, up 32 basis points from the prior quarter end. Yields on 5-year and 10-year Treasuries rose by 19 and 12 basis points to finish at 3.92% and 4.3% respectively. The 30-year Treasury yield increased by just 4 basis points, rising to 4.88% at quarter end. Cash yields were slightly higher over the quarter, rising 3 basis points during the quarter and ending the period at 3.7%. After 3/4 point rate cuts in late 2025, the Federal Reserve held interest rates steady at its March meeting, leaving the federal funds target range at 3.5 to 3.75%. The Fed's next meeting is scheduled for April 28th, 29th. Incoming data on inflation, employment, and economic growth have been mixed, contributing to uncertainty about the path of interest rates. Bond markets have increasingly priced in the possibility that the Federal Reserve may not cut rates at all in 2026, a shift from rate cut expectations that were more common in 2025. At its March meeting, the Fed continued to project one rate cut in 2026, while also noting that the war could make inflation outcomes harder to forecast. Fed independence is also in the news, as current Fed Chair Jerome Powell's term ends in mid-May. The president has named Kevin Warsh to the post, but he faces tough confirmation hearings in the Senate. Fixed income returns were mixed in the first quarter. The Bloomberg U.S. Aggregate Bond Index, a broad measure of the U.S. investment-grade bond market, returned 0.05% for the quarter. Performance varied across fixed income sectors during the quarter. 4 sectors posted gains, led by 3-month Treasury bills up 0.9% and mortgage-backed securities up 0.4%. Emerging markets debt declined the most, down 1.3%, followed by long government credit down 0.8%. Over the past year, the Bloomberg U.S. Aggregate Bond Index returned 4.3%. All major sectors had positive returns, led by emerging markets debt up 7.1% and high yield up 7%. Turning to the U.S. and international equities markets, despite a market rebound on the final trading day of the quarter, the S&P 500 index ended the first quarter down 4.3%. However, the headline result does not fully reflect the level of volatility during the period. In March, the war with Iran affected both equity and fixed income markets, underscoring the role that geopolitical events can play in shaping investor sentiment and near-term market pricing. Sector results reflected shifting expectations and geopolitical developments. Following the start of the war with Iran, energy prices spiked. For the quarter, the energy sector rose 38.2%, the strongest performance among sectors by a significant margin. In contrast, financials, consumer discretionary, and information technology posted the largest declines, falling between 9.1% to 9.3% for the quarter. Investors have also taken a more selective view of artificial intelligence-related themes, as reflected in the technology sector's negative 9.1% return. The markets have been focusing more closely on potential benefits and implementation costs in AI. In recent years, market performance has been driven by a relatively small group of large-cap companies. As expectations around technology-driven disruption continue to evolve, both in terms of opportunities and competitive pressures, performance has become more differentiated across sectors and individual companies. Equity leadership also varied by investment style and company size. Value-oriented segments led returns for the quarter. Small value returned 5%, mid-value gained 3.7%, and large value rose 2.1%. Growth-oriented segments lagged, with large growth down 9.8% and mid-growth down 6.3%. International equities also finished the quarter lower. Both developed international and emerging markets posted modest declines. However, compared with the broad U.S. market, developed international markets and emerging markets held up better over the quarter, outperforming by 3.2% and 3.9% respectively. Over the one-year period, both emerging markets and developed international markets outperformed the broad U.S. market, returning 30.3 and 23.6% respectively versus 18.1% for the broad U.S. market. Regional results within international equities varied widely. Emerging markets Latin America led with a 14.7% gain for the quarter. Europe ex-UK and emerging markets Asia were the only regions with negative returns, down 4% and 1.5% respectively. Finally, we turn to our market outlook. Energy prices spiked in March and were the largest contributor to the month-over-month rise in CPI. As oil prices remain volatile, CPI and PCE will be watched closely in the coming releases. Over recent quarters, our commentary has been noting greater uncertainty in the markets. Headline news has continued to whipsaw markets through the first quarter, hitting particularly hard in March with the start of the Iran war. The markets remain uneasy with geopolitical developments, inflation, economic growth, monetary policy, and AI-driven themes in focus. However, it is also worth noting that markets recover. The rotations can be hard to predict, challenging investors who try market timing strategies. Long-term investors are historically best served by remaining invested. This closes our quarterly market commentary for the first quarter of 2026. Thank you for listening.